In 1997, Hong Kong was the undisputed capital of Asian finance, richer, faster, and more connected than any city on the continent. Singapore was smaller, quieter, and largely ignored by global bankers. Today, that story has flipped. Billionaires are moving their fortunes out of Hong Kong. Global banks are opening headquarters in Singapore instead. And the city that once ruled Asia's economy is now fighting just to stay relevant. This is the story of how Hong Kong lost. And why it may never get it back. Welcome back. Today we're diving into one of the most fascinating economic rivalries of the 21st century, Hong Kong versus Singapore. Two former British colonies. Two tiny territories with no natural resources. Two cities that built entire economies out of nothing but location, law, and ambition. For decades, Hong Kong was the clear winner. It was the gateway to China, the busiest port in the world, and home to the region's largest stock exchange. Singapore was seen as the smaller, stricter cousin, safe, orderly, but never quite as exciting. But somewhere between 1997 and today, the balance of power shifted. Family offices packed their bags. Multinational headquarters relocated. Talent stopped flying to Hong Kong and started flying to Singapore instead. So what actually happened? Was it politics? Policy? Or something deeper, baked into the very foundations of these two cities? Stick around, because by the end of this video, you'll understand exactly why this shift happened, and why many experts believe it's permanent. Point 1. Two cities, one blueprint. To understand how Singapore overtook Hong Kong, we first need to understand how similar these two cities actually were. Both were British trading posts. Both had almost no farmland, no oil, and no major industry when they started. Both bet everything on becoming trade and finance hubs, using low taxes, common law legal systems, and open markets to attract global capital. By the 1980s, they were often called the twin tigers of Asia, alongside South Korea and Taiwan. Hong Kong had the edge in raw financial power, it was closer to mainland China, had a more developed stock market, and served as the primary conduit for foreign investment flowing into the world's fastest-growing economy. Singapore, meanwhile, played the long game. Its founding leadership made a strategic decision that would define the next 50 years. They would build not just a financial center, but an entire ecosystem, stable government, aggressive long-term planning, and total control over the variables that could scare away global capital. Here's the key difference most people miss. Hong Kong's advantage was geographic, it sat right next to China. Singapore's advantage was structural, it built institutions designed to outlast any single leader, any single crisis, any single decade. Geography is fixed. Structure can be engineered. And that difference would end up mattering more than anyone predicted. Point 2. The 1997 handover, the turning point no one noticed. On July 1, 1997, Britain handed Hong Kong back to China under a framework called One Country, Two Systems. The idea was simple: Hong Kong would keep its own legal system, its own currency, and its own freedoms for 50 years. At the time, most investors weren't worried. Hong Kong's stock market kept booming. Its port kept growing. On paper, nothing had changed. But quietly, something had. Every major decision in Hong Kong now had an invisible second layer of approval, one that answered not to Hong Kong's own institutions, but ultimately to Beijing. For years, that layer stayed mostly invisible. Businesses adapted. Bankers stayed. Singapore, at this point, was still seen as the safer but smaller option. Then came a series of shocks that tested the relationship. The 2003 SARS outbreak, the 2008 financial crisis, and a growing wave of political tension between Hong Kong's population and Beijing's central government. Each crisis was survivable on its own. But each one also nudged global capital to ask a quiet, uncomfortable question: what happens if Hong Kong's autonomy doesn't hold? Singapore never had to answer that question, because it never had that vulnerability in the first place. It was a fully sovereign nation with one government, one long-term plan, and zero ambiguity about who was in charge tomorrow, next year, or in 20 years. That certainty became Singapore's greatest export. Point 3, 2019, the year confidence broke. If there's one single moment historians will point to as the turning point, it's 2019. Mass protests erupted across Hong Kong, triggered by a proposed extradition bill. For months, the city that never stopped moving, its trading floors, its shopping malls, its airport, was disrupted by unrest on a scale no one had seen since the handover. Then, in 2020, Beijing introduced a new national security law for Hong Kong. For business leaders and legal experts around the world, this was the moment the invisible risk became visible. The line between one country, two systems, and simply one country suddenly felt thinner than ever. Here's what most people don't realize: capital doesn't run from danger. Capital runs from uncertainty. A hurricane is dangerous but predictable, insurers can price it. A city where the legal and political rules might change overnight is uncertain. And uncertainty is nearly impossible to price. Family offices, hedge funds, and multinational headquarters began quietly relocating. Not all at once. Not dramatically. But steadily, a slow bleed that, compounded over several years, added up to a historic shift in capital and talent. And Singapore was standing right there, ready to catch every single one of them. Point 4, Singapore's takeover strategy. Singapore didn't win by accident. It ran what can only be described as one of the most disciplined economic recruitment campaigns in modern history. First, tax incentives. Singapore streamlined its family office tax schemes, making it dramatically easier for ultra-wealthy individuals to relocate their entire financial operations there. Second, diversification. While Hong Kong doubled down on being a pure finance and trade hub tied to mainland China, Singapore expanded aggressively into technology, biotech, green energy, and advanced logistics. This meant that when the finance sector faced global headwinds, Singapore had other engines still running. Third, and most importantly, political stability as a product. Singapore marketed certainty itself as an asset. Same legal system next year as this year. Same government next decade as this decade. For any institution managing billions of dollars, that predictability is worth paying a premium for. Fourth, aggressive courting of exactly the industries Hong Kong was losing. Singapore rolled out red carpet visa programs, streamlined company incorporation, and built out infrastructure specifically designed to make Western and Chinese firms alike feel comfortable relocating their regional headquarters. The result was staggering. Singapore's status as a wealth management hub surged, its stock exchange attracted new listings that once would have automatically gone to Hong Kong, and its population of ultra-high net worth residents ballooned. Meanwhile, Hong Kong wasn't standing still, but it was fighting yesterday's war. It kept leaning on its historic advantage, proximity to China. But the world Hong Kong was built for, one where China's growth was the only game in town, was no longer the world it was operating in. Point 5, the plot twist. Is Hong Kong really lost? Here's where the story gets more complicated than most headlines suggest. By the mid-2020s, Hong Kong actually staged a partial comeback. Its stock exchange saw a resurgence in new listings, IPO activity climbed sharply, and in several major financial center rankings, Hong Kong reclaimed a top 3 global position, even edging back ahead of Singapore in some surveys. So is the title of this video misleading? Not exactly, and here's why. Hong Kong's rebound has been driven almost entirely by one factor: its unmatched pipeline into mainland Chinese capital. When Chinese companies need to raise money internationally, Hong Kong is still the easiest bridge. But that's exactly the problem. Hong Kong's comeback proves it can still win as China's finance arm. What it hasn't done is win back the role it used to play, a neutral, global hub trusted equally by Western capital, Chinese capital, and everyone in between. Singapore captured that neutral middle ground, and once trust like that shifts, it rarely shifts back. Businesses that relocated their regional headquarters, family offices, and long-term operations to Singapore aren't rushing to move back just because a quarterly ranking changed. Relocation is expensive, disruptive, and reputationally risky to reverse. In other words, Hong Kong may still win battles. But the war for being Asia's default neutral hub may already be over. Point 6. What this means for the future of Asia. Zoom out, and this isn't just a story about two cities, it's a preview of how the entire global economy is realigning. We're moving into an era where capital cares less about pure economic opportunity and more about long-term institutional certainty. Cities and countries that can guarantee stable rules, stable courts, and stable governance are pulling ahead of cities that offer bigger short-term upside but greater long-term risk. Hong Kong will likely remain enormously important, as China's financial gateway, as a listing venue for Chinese companies, and as a hub within the Greater Bay Area megaregion. But important and irreplaceable are two very different things. For the first time in its modern history, Hong Kong is no longer the automatic, unquestioned default choice for global capital in Asia. It now has to compete for that title, something it never really had to do before. And Singapore, once seen as the smaller, sleepier sibling, has become the region's new center of gravity. So, did Hong Kong really lose to Singapore forever? The honest answer is more nuanced than the headlines suggest, but the underlying trend is real. Hong Kong lost something that's almost impossible to rebuild once it's gone: unquestioned trust as Asia's neutral financial center. Singapore didn't just get lucky. It built certainty as a product, sold it relentlessly, and captured a generation of capital, talent, and headquarters that may never fully return. This isn't really a story about two cities. It's a story about what happens when stability becomes more valuable than opportunity, and what any city, company, or even individual risks losing when uncertainty creeps into the foundation everyone else is relying on. If you found this breakdown valuable, hit subscribe. We're covering the rise and fall of global power centers like this every single week. Drop a comment. Do you think Hong Kong can ever reclaim its old position, or is Singapore's lead now permanent? And if you want the full deep dive on how Singapore engineered its economic rise from scratch, check out the video on screen right now. Thanks for watching. I'll see you in the next one.